Okay, welcome everyone. We'll start our lesson 3. Today lesson will go through understand the risk involved in external audit process, and of course external audit is the link with the internal audit as well. So my discussion will be related to internal and external audit both. So we can contextualize our discussion. So before starting this lesson about LO3, so first of all, we just a bit recap what we learned in LO1, LO2. So anything you remember from lesson 1 and 2, please? What do you think? What we learned?
So lesson 2, we studied about responsibility of management. What are the rights of the auditor, and what are the responsibilities of the auditor? What ethical how you should conduct himself ethically while performing an audit, and then different audit procedures.
Excellent. So we discuss about different audit procedures. We discuss about ethics. Yes. We discuss about risk. Yes. What sort of the risk can be if we don't. We discuss about internal audit. Yes.
Yeah, difference between internal and external audit.
Excellent. We discuss about internal audit within a company, within not compulsory to do so, but is good to be controlled. And we discuss about statutory audit, which is meant by law the company required to do audit. So all we discuss in lesson 1 and lesson 2 about internal external audit. So today lesson is about external audit and risk. So what do you think? What will be the risk? What is meant by risk first?
Risk is basically what are the what is objectivity, and what are the problems that can arise with audit.
So risk is a probability of happening something, yes?
Yeah.
So is a high or low, yes? So we can say probability. So what do you know about audit risk? Have you heard before audit risk?
Yeah, I heard some of it before, so I will put it around 4 or 5.
4 and 5. So maybe we heard about the company called Enron. Quite big company.
Enron, I heard of it.
World Telecom, yes, we can say World Telecom, yes.
Yeah.
So World Telecom, yes, just collapsed back in 2004. So these are the company used to be leading in the world but collapsed. Why they collapsed? Due to the reason is all about because the audit, yes.
Yeah, I heard they had put false information to portray them in a good situation.
Yeah, so we should give the true and fair information, yes. Detailed law. Give the views about going concern. Do we know what is meant by going concern?
Oh no, I forgot.
Going concern means the business will carry on as normal, yes? At least twice. So that's, okay. So today lesson inductive content, what we supposed to be. Audit risk. Audit risk has 3 types of risk. Inherent risk, which is inherent. Control risk and detection risk, yes? So these are the risks we have. We have to assess these risks. We have to minimize the concept of materiality. Do we know what is meant by materiality?
Materiality must be correct and revolves around the stakeholder.
Yes, we can say, but materiality mean material things, yes? If you don't involve it, yes, we can't really properly minimize them, yes? So we need to make sure materiality is mean significance, and we need to make sure we can minimize them, yes?
Reduce make financial statements as easy as possible to understand.
Excellent. Yes. So it's all the material information should be contained into
Yes.
financial statement. Yes. Audit
Good.
engagement. Yes, we engage with the various stakeholders. We can prepare the entity ratios. Yes. So this is all about which we discuss a bit, which we can cover in our discussion as well. So what type of the risk we have? So this slide will explain itself, and thus we can further divide our discussion. So audit risk, the risk of issuing an inappropriate audit opinion. Appropriate audit opinion should be based on the factual information. If we're not giving those risks, we not identify Enron. We did not pick those risks in what the Enron have. So they misled the stakeholder. Yes. So they should be.
Oh,
So it means audit wasn't appropriate. Yes, we can say. That's, okay. Any question here?
no, this is fine.
Okay, then we can balance off misstatement for the consideration of control. So inherent mean whatever the culture we have an inherent risk, you know. So we need to be like, you know, sometimes people say, come on, yes, certain
Uh,
athletes maybe have a more risky than other group, yes, because they are saying on the basis of the cultural element or looking the news something. Yes, it's not mean everyone is risky in the same ways, but we need to be look around in an organization perspective inherent. If you don't have a control in place, yes, and we don't have that type of, so that can be a risk. So we need a more control in place. So high risk, a client in a volatile industry. Think about technology industry. Think about now COVID-19. Which industry is more risky? Yes, travel industry. Yes, people
uh,
can't move it. Is an inherent risk they have. Engaging in the foreign transactions, dealing businesses in the countries where there's most fraud is happening. Rapid changing technology. That's all the risk there. Yes. So the auditor's job to be detect those risks to minimize it. Yes, give the true and fair opinion. Control risk,
uh,
the risk client control fail to prevent it. So client control system, like they are dealing with the cash, yes. So they're paying the salary with the cash. They are doing purchases with the cash. What are the risk involved there? If they're doing through banks, is a less risk. If they are doing through the cash, yes, is a more risk
yeah,
involved. So what we need to do, we need to make sure the control in place that risk can be deducted and fraud can be prevent. Yes,
yeah,
high risk, old ineffective accounting software. Anybody can enter the data. Anybody can amend it. I can say today, I'm sitting on the same system. Someone else can use the same system. We not allocate the password. Anybody can sit it and can amend it. There is a no segregation of DFT. That's the big risk can be segregation of DFT, the poor control. Lack of authority, authorization. Any loan you can sanction, yes, in the bank. So that's a more risk. So there should be a authorization procedures involved. Deduction risk, the risk that a debtor failed to deduct. So that itself, material misstatement. Higher risk, using inappropriate procedure and misinterpreting the result. Result is clearly saying the company is going down and we not interpreted the signal. Yes, the companies will be down in our audit. Okay, so audit skepticism, audit risk, control risk, inherent risk, detection risk, and now we'll go through audit is the risk that a debtor expressed an inappropriate opinion. Audit risk. If you do audit, there are the risk itself. Yes. If you give the inappropriate opinion to someone, what will be happen about that company? Yes. You should give the true and fair opinion about the company, not mislead it. Modern auditing use this approach, the main principle explaining IS 200. What is IS? International Standard of Auditing 200. Overall objective, independent editors and conduct of an audit according with ISA. What is ISA? International Standard of Audit. Yes.
Yeah.
Nowadays we do risk-based approach. What is a risk-based approach? To obtain the reasonable assurance. The auditor not relies on the management, they confirm from the third party evidence. Yes. Obtain appropriate evidence to reduce the audit risk. An acceptable level. Acceptable level, let's say, we checked 1,000 invoices, there was 2% or 5%, the invoices was mismatched, but the rest was matched. So what is the risk there? Risk is the minimum, yes?
Yeah.
So International Standard of Auditing 315 identify and assessing the risk of material misstatement through understanding the entity and its environment which stated. The objective of auditor to identify, assess the risk, material misstatement, whether due to the fraud and error. Error is allowed, fraud is not. So what is system we have in place to protect the fraud? Financial statement assertion level through the understanding the entity and environment. Internal control do we have? Designing and implementing the responses to assess the risk. Material misstatement. In simple term, a auditor identify the risk, material misstatement, and they use this guide design of their audit testing procedures. Okay, the component of auditing. As stated previously, audit is the risk of the auditor express an inappropriate opinion. Here we're not looking the business risk. Audit itself is a risk. Yeah? Okay. It can be further divided into following subcategory risk. Inherent risk. This is the susceptibility of the class of the transaction. Accounting balance. Disclosure of misstatement could be material, either individual or the aggregate. Before considering the related control, in other words, the risk of misstatement occur in the first instance. Inherent risk often considered in the relation to the business risk, resulting of the condition, event, circumstances, action, inaction could be adversely affect the entity ability to achieve the business objective and goals. Ultimately, these risks can lead to the complication, deficiencies in the accounting process, and which could lead to fraud and error. Any question here?
No, this is fine.
This is straightforward, yes? Okay.
Yeah.
Then next we're looking control risk. We'll go through the control risk. This is and detection. This is the risk in misstatement when not prevent or detect. Corrected on the timely basis. Internal control. If you have your internal control should pick it and rectify it. If somebody not sign it the check, you saying no problem. Your internal control say come on. This is not sufficient. There should be a 3 copies. Yes. Whoever draw the money from petty cash should be 3 copies voucher. Yes. So these some material have not been applied effectively during the period. We will consider the internal control is a depth in later text which we will go through. Detection risk. This is the risk procedure performed by the editor to produce the audit risk to an acceptable level which not detect the potential material. So we did the audit, we picked 10% sample, but that sample not detected because we picked first 10 transactions. First 10 transaction was really absolutely fine. So our sample should be, we'll pick it randomly, we pick it whatever criteria we'll use. This should be reflected, yes, overall procedures. We can't do every paper, otherwise take pages. So our sample is not appropriate to reflect it. Yes. Any question?
Yeah, no, this is fine.
Okay, sampling risk and non-sampling. Sometimes detection risk is comprised of the sample risk because your sampling strategy was not appropriate. Non-sampling, sampling risk is the risk auditor can conclude based on the sample is different from the conclusion would be reached as the whole population was tested. So we will go through. Okay, non-sampling risk is the risk that a auditor concluded inappropriate for another reason. Application of inappropriate procedures or failure to recognize misstatements. Yes, may not recognize it. That can be a. Any question there?
I didn't understand sampling risk. If sampling is focused on the population, what does it have to do with auditing?
So auditor use the samples, yes, from the total population, yeah. So you need to be pick the invoices, those are appropriate. If your system not, or the audit firm system, yes, not deducted,
Yeah.
that can be deduction risk, huh? Auditor not deduct these fraud. Auditor are the fake worker in the payroll, yes, we not pick it because our
Okay.
sampling strategy not pick it, huh? Then next we're looking when you want to be minimize the risk. This is linked with the 3.2 as well. Auditors are required to obtain understanding about the client business. If you don't understand the client business, what nature of business you have? Is it mining industry? Is it a textile industry? Is it electricity? Is it which industry we are in? Yes. Some industry is more risky than others. So knowledge of business itself help you to be betterly you do the audit. Or you're a government sector organization. Separation, ownership, governance structure, types of investment, make the way the structure and the finance. Entity selection, application procedure, accounting policies, entity objective strategy we well be aware of, the measurement of the review, entity financial performance, internal control relevant to audit. International Audit Standard 315 identify and assessing the risk, are material misstatement. The purpose of acquiring this knowledge is identify the risk the business is exposed to and ultimately how could these lead to the risk or material misstatement in the financial statement. Any question there?
No, this is fine.
Okay, next we're looking risk. Look around here. Factor identify lack of physical control. There is a lack of physical control. There is a no CCTVs in place. There is a no restriction access. So what will be happen? Increase the risk of theft, yes, damage asset. Incorrect evaluation of the asset value in the financial statement. So this type of risk is called control risk. Any question?
Lack of physical controls. Does that mean? I understand it's
Physical control of assets, for suppose, yes. There wasn't any locker, yes. Let's say you are a jewelry, yes. Something physically control, yes.
okay.
So that's a control is lack of IT based control. So
Yeah,
you don't have a
how can there be increased risk of theft of assets?
oh because if you don't have anybody can damage the asset, yes.
Uh,
Yes, physical
okay.
control.
Yeah, but it's difficult to steal an
Let's
asset if it's
if you're if
okay,
you're
computers and this thing. Okay.
yes, let's say computer is a asset, yes.
Yeah, okay.
If you don't have a proper procedure to how to operate it, yes, that can be also risk as well. Itself is a control risk. Huh? Okay, lack of password, yes, there is a no system in place, yes. So that's a
Yeah,
control risk. Lack of authorization, who is authorized to do things? Anybody can give credit to anyone, yes.
yeah,
Anybody can receive money from the customer, yes. Anybody
Yeah.
can raise the purchase order, so this is the control risk. Lack of segregation, not identify errors, fraud, only one person doing the job, therefore concealment easier. One person raise purchase order, same person work in the warehouse, same person is doing in finance, yes?
Yeah.
So this is a more risk. Okay, next we look at now recommend measures to minimize risk. How we can minimize the risk. Auditors are required to assess the audit risk and reduce it acceptable level. Yes, risk always there. You can't 100% eliminate the risk, but you try to be acceptable level. Yes, 5%, 10%. Yes, not
Yeah.
100%. Conducting through the assessment of the risk, auditors will be able to identify the area of financial statement. There are the misstatement in the cash, in the value of the asset, the depreciation of the asset, fake invoices, fake workers in the payroll. Yes, for saving
Yeah.
tax. So you need to be identified. Plan procedures that address the risk. Identify which one is, yes, effective audit, minimize the risk, issuing inappropriate audit opinion. You give the true opinion, not inappropriate, yes?
Yeah.
If you're saying the company, we think this company can't be sustained in next 12 months. Actually, company have enough asset. Your words can be make itself the company reach to that point. If we'll put the news in on the media that this bank is likely going to be liquidate, yes?
Yeah.
Even what will be happen, the people will draw the money, yes, by the risk itself. Ultimately, of course, there will be banks will collapse. Reduce the risk of reputation damage through the risk assessment, fundamental elements of the planning. It's important to understand the risk uncovered at any stage or detail, and the procedure must be adopted in the light of revelation, and we need to be indicate the further risk. Yes, material statement. Ultimate, we need to be well aware of. Any question this one?
Yeah, you said that there is no way an audit risk can be zero.
Yes, no ways or details can be reduce 100% eliminate the risk. Yes, but we need to be reduced up to acceptable level. Huh?
Yeah. Okay.
Okay, next now understand the entity and environment as we discussed in that 3.1 as well. Yes, so you need to be best understand nature of the business. If you understand the nature of the business, you understand the risk. Yes, like think
Yeah.
about dealing with the foreign currency. If your business,
Mm.
what is the risk? Currency fluctuation is a lot due to anything happen. Election in America can affect it. Yes, because
Yeah.
we are very interconnected economies nowadays. Okay, relevant industry, regulatory and other external factors. So you need to be think about reporting framework, operation, ownership, governance, type of investment, the way the structure and finance. If you have a 90% debt and 10% equity, your gearing ratio is a 90%. What risk? You learn about ratios, yes?
Yeah.
So if your gearing ratio is coming 90%, what is the risk there?
No, the gearing is higher. That means it's more risky for the business.
Yeah, so it's a more risky. So the reason is because high gear mean you have a more debt. If you
Yeah.
can't afford it to pay back the debt in any 1 year, yes, 90%, so is high risk, yes. If you look around interest cover ratios is coming only one time, yes. So if your profit drop, you can't maybe make the payment to the creditors. So internal control relevant. Once we get the loan, who authorize it, how much we borrow it as a country, as a company, even yes. So we should have a strong audit department, strong transparency. Okay, next we're looking there. The information used to complete these references can come from the wide range of source. Yes. including information from your firm, information from you, information from external source, and information from client. Yes.
Yeah.
So you have to manage that information. Yes.
Okay.
Any question?
No, this is fine.
Okay, risk assessment procedure IS 15 require the editor to perform the following procedure. Understand. So we can look around analytical procedures. Yes. You look around internal control. You look around the segregation of DT. In the further slide, it's further observation your own. Yes. You
Yeah.
do inspection. If you stand there, what the people are doing it. Yes, a editor come just observe it. Yes. And can write on reports. Yes. Okay, next we're looking inherent risk. So account balance is complex. Judgment area of accounting provisions. What is the provision? We kept the bad debts provision 2%. Actually, bad debts are more, yes?
Yeah.
Because due to the COVID-19, people can't afford it and we kept it 2%. It's an inherent itself, yes? Due to the nature of transaction high of the judgment or estimate involved, yes? Therefore, the open manipulation of that. Client operates in the high-tech, fast-moving industry. Inventory can be obsolete. Think about you have a Windows 98 CDs. Yes, itself is an inherent with the nature of the business itself. The client base multiple location. When you have a multiple location in your business, what will be happen? Maybe you have a control risk there. Yes. And detection risk. You can't detect the fraud properly. Control may be less effective. Bank is relying on the financial statement. Director are paid on the bonus based on the profit. Risk of management bias. Yes. If you show more profit,
I think the biggest audit risk with client-based multiple locations is the foreign currency exchange.
yes, that can be. Depends if many country or many location within a country. Yeah.
Yeah.
So depends. Huh? So types of risk can be cash. In cash, what risk you have? It is the cash-based business. Think about it. Can be inherent risk. It can be control risk. Yes, anybody can steal the cash. Cash may
Yeah.
be misappropriated, causing the turnover to be understated. Yes.
Yeah.
Complete trade overseas. The transaction in the foreign currency may not be translate correct rate. Yes, different rate is the different times of the year. Maybe you under or overestimate your rates, for the sake of your own profit. New computer system, maybe you have a data not reflecting properly. Yes.
Yeah.
Control risk and inherent risk. Okay, then audit. New audit client is a new audit client. Yes. You don't have a lack of knowledge and experience about that client. So that deduction risk, maybe you not deducted fraud properly. Tight and audit deadline. If you have a tight deadline, maybe you have to finish audit on the 30th. Yes, it's a big organization. Your two auditors working. Can you check everything? No. So there is a deduction risk. Temporary staff during a year. So temporary staff, that can be control risk. Yes, not the client is specialist industry, inherent risk. Yes.
Yeah.
Any question?
This is fine. Finding different risk and associating the type of risk is fine.
Excellent. So we discuss about independent auditors is the objectivity. Always give follow ISAs, audit
Yeah.
approach, risk-based approach. You identify the risk. Auditor always assess the risk. Risk-based required under the ISA 315. Yes. Audit
Yeah.
risk, inherent risk, control risk. This inherent risk control risk is the entity risk. Yes, it's come from
Yeah.
organization. Deduction risk, it can come from audit firm itself, not deducted. Yes? They don't have
Wait,
knowledge.
I didn't see entity risk earlier.
Sorry.
I didn't see entity risk earlier. Release of detection, inherent and control.
Yes. Entities mean the organization, yes.
Okay.
So nature of the business, it can be risky, yes.
Okay. Okay.
Okay. So then next we're looking the knowledge is the key assessing risk. A data need to be know about the client environment. As now this what we discuss is summarized in these mind maps, huh? Yes.
Okay. Yeah.
Okay. Materiality, we discuss material is something, it's significant, yes.
Yeah.
You need to be make sure design the audit procedure to reduce the risk material misstatement. Establish and apply the performance. Assurance, yes, you get from the third party. Always look around the value. Auditor must be examined the material item. Account with the miscellaneous cannot be shown the true and fair. Huh? Okay.
Okay.
I 300. You need to be, they are the audit strategy, yes. Engagement factor, seek reporting objectives, significant engagement factor. Time off, yes, when will deploy the resources, management direction, supervision all. Audit plan. You need to look around the time, you need to look around the risk assessment. You plan everything, yes.
Yeah.
Material statements, yes. Departments, time, cost, everything you need to be well planned. Any question there?
Yeah. The difference between audit strategy and audit plan is a bit confusing. How do you know
Okay,
which goes into strategy and which goes into plan?
basically strategy is action plan, yes.
Yeah.
And the plan is a future, yes. Yes,
Uh,
strategy, what you do to achieve your plan, huh?
okay. So strategy is what you want to do now, and plan is what you wish to achieve in the future.
Yes, that's all you know. What you want to end up the course of action. Yes, what you
Yeah.
do, what you will achieve. Okay, this you will see the strategy,
Yeah.
correct framework, yes. Industry reporting, knowledge about business, internal audit, look around all, nature and the timing, reporting objective and the time and the communication, significant factor, look around the materiality, assess the risk, need to be professional practicism in look in the professional guidelines, internal audit, yes. Internal audit also reduce the risk for external audit as well. Huh?
Okay.
Okay, then we discuss audit planning. Yes, meet the
Yeah.
deadline, set the timetable, identify the problems, assess and address the risk. Yes, all these point efficiency, effectiveness of your audit. So this we need to be make sure we'll follow it. Yeah. Okay. Then responsibility of fraud and error. You engage the management. Yes.
Yeah.
Management is responsible and auditor is responsible to detecting the fraud. Huh? Give own opinion. Huh? Yes. So
Yeah.
they can ask any document from the management. Auditor has the right to see it. Yes. To reduce the risk because they can develop the opinion properly. They can visit to the supplier, they can visit to the various clients. Huh? Otherwise, they can't give the opinion without. Huh? Okay, IAS 25 laws and regulation. Auditor need to be follow the laws and regulation. Is the what are the responsibility of auditors and what are the responsibility of directors? Huh?
Yeah.
Any question?
No, that's it's completely fine.
Okay. So next now we'll look financial statement transaction. So when we're looking the audit, yes. So look around the transaction events. You should be occurrence. If the real transaction happen, yes. Check the
Yeah.
company who raised the order, yes. Check the accuracy. Check the cut-off date, yes. When you start and when finish. Classification this transaction come under which, and presentation, yes. This transaction being presented or not. When you look at the account balances, look around existence, right and obligation, completeness, accuracy, valuation, and allocation. It's been allocated under the current asset, non-current asset. Is that it was asset, we deduct it expense, yes, types of errors, yes, classification
Yeah.
and presentation. All you look balancing. Any question there?
No, this is fine.
Okay, audit technique, analytical procedures. You do inquiry and external confirmation. You do inspections. You use observation and you use recalculations of the things to check his accuracy. So IAS 3602 is expert person. Yes, knowledge about some sufficient appropriate opinions. Yes, if you
Okay.
assume something should be based on something. Yes, sources of data. Any question?
Um, auditor's expert is different from the auditor.
Expert person. Yes, auditors and expert. Yes.
Yeah. Okay.
They should be expert in those areas. They should be registered with the in the audit firm. They have experience. They have a CPD. Yes.
Yeah. Correct.
Okay. IES 610 using the work of internal audit. Internal audit work can be used for external audit purposes to verify it. So we can see some evidence. Is it the audit is how much is the reliable? Yes, sometimes can be problem.
Okay.
Okay, thus we need to make sure. Then we need to computer assist audit techniques. We can use different data, different software to do audit and test the data, yes.
Yeah.
And then I copy the link for you to watch the video further enhance your understanding, yes.
Yeah.
Watch this video, please. And I copy the further reading, ACCA article, please.
Okay.
So that's also. So all today we learn about different types of risk. So we learn three major risks. What those are? Audit risk.
Uh, in inherent risk, control risk, and detection risk.
Brilliant. That's all we learn. Huh? Well done. That's
Yeah.
all today's lesson. And if you have any question, anyone, those are listening this recording, please drop me email and copy into the learner work at ukversity.co.uk. And I hope so I'll speak to you during our next lesson. Thanks for listening and attending this lesson. Thank you. Bye-bye.